Hi, welcome back. You're listening to That Can't Be Right, a podcast about exploring structural wrongs, cultural oddities, and wild opinions. I'm your host, Ryan Rogan, and today we're talking about money and the institutions that hold our money for us and how they suck, but also a model from our good friend Angela Merkel on how they could be better. But first, to borrow a phrase I heard on the internet, smash that subscribe button, leave a review, tell a friend, and I just published a list of topics I want to cover on That Can't Be Right. The link is in my internet biographies on Twitter and Instagram at TCBRPod. Or if you have any ideas, send an email, thatcan'tberightpodcast@gmail.com. And now, my guest today is Mark Cassell, professor of political science at Kent State University, where he teaches public policy and administration courses, European politics, comparative public policy, and urban politics. He's also the author of Banking on the State, the political economy of public savings banks. Let's go directly to the source to find out what that means. Your book focuses on German public banking, and then as a conclusion, kind of like German public banking as a model for what we could do in the U.S. But what is German public banking?
Right. That's a great question. Thanks so much for having me. So public banking, at least in the generic sense, is really no different than any other kind of banking. It's like a community bank or a credit union or a savings and loan. It's just that the stakeholders also include the public. So it's not just shareholders or the owners or partners of a bank. It really is the broader community. It can be a city or it can be a county. In the case of, for example, the Bank of North Dakota, the main owner, the stakeholder, I should say, is the state of North Dakota. And in the case of Germany's public savings banks, typically the owners or the body that oversees those banks tend to be cities or several large cities and maybe a county. So in Germany, for example, there are close to 380 public savings banks. And they really are interesting because they are located literally in every single county in the country. And that's kind of what makes them public, is they can't just, for example, they can't just leave certain sections of the country. So it's sort of in a way ensuring that there really aren't any parts of the country that are unbanked. And I think many of your listeners are probably aware of what some of the downfalls are. For a place to get a loan, you end up relying on some pretty awful alternatives like pawn shops or check cashing stores or payday lenders, which can be really not only exploitative but really harmful, not only to individuals and families, but really whole communities. So the public banks in Germany are these public institutions, and I sometimes say they're owned by the public, but they're really not owned in the traditional sense. In other words, you can think of them in the same way we might think of like a fire department or a police department. Like they're public, but it isn't like a city can just sell its police department or sell its fire department. I mean, they oversee those departments, but they're in a sense kind of like a public works. And they, as I said, they exist in every part of the country, and they really are a product of the 19th century. In Germany, sort of the Industrial Revolution led to lots of migration into cities, and you had a large body of the population that really suffered from exploitation and poverty and all the ills that come with city living. And the issues that they faced the financial issues they faced were ones that many people today face, which is they didn't have a place to put their money, a place to put their savings, and they didn't have a place to go to borrow money. And so the biggest institution that they could turn to borrow money were pawn shops. And so actually in Germany, a conservative regime, really an authoritarian regime, created these institutions for the most part to try to get the population, in this case workers and poor people, to kind of buy into this new capitalist economy. In the 19th century, capitalism was very new, and there was clearly concern that people might rise up and opt for a different system. And so the leadership created these institutions, these banks, really to get workers and poor people and others to basically invest in this capitalist system by basically depositing their savings, and then later on being able to borrow money. So they're really, in some ways, this sort of irony, because they're often, public banks in the United States are often billed as these products of, or these policies that progressives are pushing. But the origins of public banks are really very conservative in nature.
Yeah, I do remember reading that. So Mark
Mm-hmm.
has a very interesting, very good book, State of Banking, or State. Wait, help me with the title real quick.
Banking on the State.
Banking on the State. I'm doing great, team. Banking on the State. And he talks about how, essentially what he just said, that the bank was a way to pull people away from the draw of the evils of communism.
That's right.
At one point. So I found that very interesting. And like you're saying, it's politicized to be something that's very progressive, that will somehow harm competition in business or whatever. Is very interesting and almost the complete opposite of the origin story. So
yeah,
something I'm particularly interested in is the public mandates of like a public savings bank, as opposed to the mandates that JP Morgan or Wells Fargo or whoever has, because a quote that appears throughout the book is the public savings bank is for profit, but it's not profit maximizing. How does that take shape at a public savings bank based on those mandates?
That's a great question. And I think it highlights a couple of different things. One is that, the term public bank really is an umbrella term that covers lots of different types of banks. So, if you think, for example, the Bank of North Dakota, which in the United States is the only real public bank that's been around for almost a century, the Public Bank of North Dakota isn't a bank where you or I could deposit our money. It's a bank that basically takes all the tax money that is paid into the state at different levels of government, the city, state government, and it essentially uses that money as capital to create essentially a pool of money that community banks in North Dakota can tap if they, for example, are interested in making a loan or want to make an investment but they're too small. So the Bank of North Dakota is one model where it's really a complement to community banks. So that's sort of one. In Germany, the public savings bank really operates, as I said, at the very local level, although it's part of a larger network, but it operates for the most part at a local level as a for-profit institution. Then there's also development banks, right? So there's also institutions that look a little bit like community development financial institutes, CDFIs, you might be familiar with, that are really arms of government in some ways. So they're basically arms that try to raise money and then spend money on specific capital projects. In any case, it's important to at least recognize that public banks can be a variety of different things, and there's just not one sort of cookie cutter version. But to your question, it's a really good one. And I stress it all the time. Public banks in Germany, public savings banks, are really for-profits. They're for-profit institutions, but they're not profit maximizing. So a JP Morgan or Bank of America or Wells Fargo, they have a fiduciary duty to maximize their shareholder value. At the end of the day, they make decisions that will maximize the value of their shares to their shareholders. They can't really do anything other than that. They're not allowed to. And in the case of Germany, the public savings banks really don't have that mantra. They, in addition to earning a profit, they also have a mandate to, for example, to promote savings and asset building in the community, to ensure that there are financial services available to individuals, to households, to businesses in that community, to maintain a presence in a community, right? So they can't just pull out. That's prohibited. And in fact, one of the features of public savings banks is that they are literally constricted to a geographic area for doing business. So part of that is so that they don't compete with each other, right? So they're in all these counties, but they can't just say, oh, this other county, 200 miles away, which is really wealthy, I'm just going to go there, right? So if you're, say, in a rural part of Texas and you're a bank, and you think, oh, all this stuff is happening in Austin, I'm just going to, I might have a an office wherever I am, but I'm going to do all my business in Austin. Well, you can't do that in Germany. That's not allowed. So
Yeah.
what that means, of course, then is that it creates a really important incentive for that bank to really invest in its community, because at the end of the day, its community is what enables it to survive and thrive. So, and one other point about the mission or the mandate, I should say, is that it, as I said, it's a public entity, so it's an entity under public law, and really what that means is that it can't be sold. It's like, again, a public works, or it's like a fire department. It cannot be sold. It's a public entity that's subject to all the disclosure rules of any other public organization. And when I say it promotes savings and asset building, it really does. In other words, what that looks like in practice is that it does a lot of education. It actually goes into the schools, talks to kids about savings, about money, about investing, and all kinds of things. And it really promotes savings. It really sort of emphasizes. I mean, they're not neutral on the question of savings. Obviously, they want people to save. They don't want people to spend. They want people
Right.
to use their money wisely. And so that's often part of their message. And that plays out in every walk of local life. And it's, I think, one of the reasons that when you go to a place like Germany, regardless of where you land, whether you're in a big city or a tiny town in the north or south, east, west, everyone is familiar with the savings banks of Germany, partly because they were exposed to them at a very young age, and also primarily because they literally are in every single community in Germany. So, oftentimes people will go into even a small city and they'll see three institutions. They'll see City Hall, they'll see a church, and then they'll see the savings bank. And they really do, in many ways, sort of equate all three as important institutions for local governments and democracy.
I think that's a really important feature of the system, right? Because I remember at the onset of the pandemic, Wells Fargo, I think, had announced, oh, we're going to close a ton of branches all over the country. Or like you're saying, I'm going to move and do all my business in a metropolitan area, leaving these areas unbanked, underserved, where people aren't participating in the financial system. So for this system, the public savings bank, to exists all over the country, and like you're saying, you're going to see it no matter where you are in the country. I think that's a really important feature that should be replicated. And I have a question and a point of clarification. I think businesses in the US always feel like, oh, but if we're in this area, we're not going to perform well. Is that how it plays out for the public savings banks in Germany? Like the rural ones don't perform as well as the ones in the city centers?
Well, so it cuts both ways, right? So on the one hand, you could make the case, and obviously they do, is that the savings banks that are in the more impoverished areas or in the more rural areas don't have the same opportunity to lend money to businesses. But on the flip side is they don't have nearly as much competition, right? So in the large cities, a savings bank might have to compete with a Citibank or some international bank or whatever. And but in the more rural areas, in the local areas, they don't have quite the level of competition. The other way in which those banks overcome some of that problem is that it isn't that they don't invest their excess money. So the way in which you think about a bank, just as a little sidebar, the way banks usually work is, in the traditional sense, you and I, we have our savings, we put our savings in the bank, and maybe we get 1% now. We used to maybe get 2 or 3%. But in any case, we might be the same person, or maybe our neighbor goes to that same bank and they want to borrow money to buy a car or to buy a house or whatever it is. And for that, the bank will charge them 4% or 5%. And the difference between the money that they pay you for your deposits and the money that they get from the customer that they are lending to is what they take as profit, right? So that's in a very traditional kind of very boring classic way. That's kind of how banks make money. In more recent years, the other ways they make money is through commissions, and that's become more and more popular as financialization has occurred, as we've grown in terms of the kind of our assets, our equity assets, the different kinds of funds that banks create in the market and other ways. those other kinds of commission-based sources of income have grown in importance, and they're not trivial, and they're
Hmm.
important. They create a lot of profits for lots and lots of banks, and savings banks aren't immune to them. I mean, they also invest in those things, and if you're in a community, for example, that is relatively poor or sparse, what that means is that the bank might have excess money. It might have more deposits than it's lending out. And so it'll take that money and it'll invest it, but it'll do it through its network. So the savings banks are part of a larger network. And they have, as part of that network, they might have an institution that in fact does security sales. But those security sales, which are part of the network, and we can talk a little bit what that network looks like, but
Hmm.
that will ensure that the assets that are purchased by the local savings bank are in keeping with the risk appetite for that savings bank, right? So they are not going to, because they're part of the savings bank, public savings bank network, the institute that sells, for example, those assets, those financial assets, are going to do it in a way that's in line with the priorities of the entire savings bank system. And the reason that they do that is because every part of the savings bank network shares liability for every other part. That's a really important distinction. In the United States, banks are secured by or deposit, or first of all, banks aren't secured, it's deposits. So we have our Federal Deposit Insurance Corporation, which is
Hmm.
this fund that essentially ensures that you and I feel safe about putting our money in a bank. In Germany, they have funds. Public savings banks have funds, but they really don't insure depositors. They insure the institutions. So what that means is that no institution can ever go bankrupt. It means that, and the reason that they don't is that the entire network shares liability in the activities of any savings bank or any part of the network. So, for example, if a savings bank maybe got unlucky or maybe had some loans that went south, it means that their neighbor savings bank or the savings banks in other parts of the country would have to cover the losses of that savings bank. And that gets back to this sort of asset question. That means that when they're essentially investing in funds to sort of help the profitability of a poor savings bank, they do it in a way that's in line with the risk appetite of that savings bank because they themselves might very well be liable for any losses that savings bank does. So it creates an internal incentive to remain fairly safe and sound, which was reflected in the financial crisis. It was reflected more recently in the COVID-19 pandemic. But basically, to answer your first question, I visited actually savings banks in very poor parts of the country and in very wealthy parts. And I was really surprised that even in the poor areas, you had some of the best performing savings banks. Because at the end of the day, everyone needs a place to park their money. Maybe not everyone needs, mortgage-backed securities or whatever, but everyone, no matter how wealthy or poor they are, they need a place to keep their money safely. And so they serve that purpose.
So your last phrase brings up a very interesting point. I'm always going to refer to like U.S. based banks because I'm only familiar with the U.S. based system, but they offer so many products now. They offer credit cards and mortgages and small business loans and all these sorts of different offerings. Kind of bloated, maybe? Is that an issue in the public savings banks, or are they just really tailored to meet the needs of the community they're operating in?
That's also a great question. I mean, so it isn't just, I wouldn't just say that they're bloated. I think where you really see what you're describing is in the area of technology, right? I mean, you and I, we rely on our smartphones to do a lot of our banking, or at least most people, many people do.
Mm-hmm.
They use Apple Pay or they use some other service. They transfer money using Venmo or PayPal. So the technology has really dramatically changed banking and the way we know it. The problem, at least in the United States, for community banks, which in some ways are analogous to public savings banks in Germany, the problem that they face is that adapting to this new technology is really costly. It's expensive. It's hard to compete because, say you're a community bank and maybe you have, I don't know, maybe 5 or 6 branches. That you're too small to sort of make the large investment. Well, fortunately, savings banks belong to a large network, and they are able to kind of gain extraordinary economies of scale when it comes to investments in things like technology. But you see it in other areas, like training, for example. Training is
Oh
another
yeah.
really costly part of any business, especially banking. You need to train people for all kinds of activities in a bank, whether it's marketing or lending or asset management or a variety of things. And because they're so large, or because the savings bank network, even though the individual savings bank might be relatively small and it's independent, because it belongs to a larger network, it really benefits from economies of scale, which allow it to kind of defer or spread the overall cost of new technology, training, regulatory compliance can also be very expensive
Yep.
across a much larger number of institutions. And so, frankly, the way in which, so to answer your question, it's an issue. Savings banks are acutely aware of it in Germany because they recognize, particularly among younger people, that being tech savvy and being adaptive to new technologies is crucial to retaining customers and gaining new customers. But as I said, the way in which they try to compete is through their network. I mean, I'll say one other thing though that on the flip side is that where I think savings banks really do benefit is that I think you and I can both relate to this. Private banks, especially in the United States, but it's not different in Germany. Private banks change all the time, right? I mean,
Yep.
how often had if you just look at like if you have a mortgage or just think about your own bank account, like, maybe you started out at one bank and then like suddenly like 2 years later, it's like been bought out by another bank. And now you're getting email from a third bank, or maybe you have a credit card that's with one bank and they sold that to another bank. I
Yep.
mean, at the end of the day, you have no idea who knows everything about you and your financial footprint because it's just too hard to keep track of it all. And
Yep.
that just is not the case with the public savings banks. One of their greatest assets really is their stability. And it plays out not just in terms of its ownership, but also even in something that we think of as benign as like a loan, right? So, if you borrow money for a car, or maybe you have enough money to maybe purchase a home, that's a big purchase for many people. Well, most people don't have the cash to buy a house, they have to borrow. But in many cases, private banks in the United States, as soon as they make a home loan, you might go to your local bank to make that loan, but then that bank immediately sells that loan to somebody else, right?
Yep.
And suddenly you have no idea who has the loan, who you're making monthly payments to. And in Germany, public savings banks don't do that. They keep the loans. They make their money on the loans. They don't make the money on the commission that comes from selling the loan. So again, it creates a very different incentive. It, on the one hand, makes savings banks don't just make loans to people to get commissions, so they are more conservative as a result of that. And they have a stake in making sure that the person who borrows the money pays it, because at the end of the day, they're making the money not from the commission, they're making the money from the monthly payments that people make to pay off their loan.
I need to stop and say, one, I read the book over the weekend. I literally wrote down like they can't sell loans. They're not going to like withdraw from a community. They're not going to just like leave people in the lurch trying to figure out like who do I need to make this payment to, and then it ends up in collections and your credit score takes a ding and then you're trying to like recover from that. All that to say, I like the system more and more as we continue the conversation. But and then going back to, you mentioned like the costs of training, and something that was really interesting in your book was how people stick with their careers in the public savings bank for a long time.
Yeah, they
I
do.
just I just finished graduate school, of course, had classmates who went into investment banking and venture capital and consulting, and it's like a quick cash grab for 2 to 3 years and then they're off to do something less stressful,
Mm-hmm.
less, right? So I think that's also a very interesting feature of the system.
Yeah, I mean, I think that, I interviewed a number of, I mean, I obviously did a ton of interviews with public bank managers, but I also interviewed a lot of people who worked for credit unions and worked for private banks, the competitors to savings banks, to get their perspective on what they think of public savings banks, why they think they work, or why they stick around. And, it is surprising to me how different just the personnel track exists within the two spheres. So, in the world of private banking, if you work for, as you say, if you're straight out of undergrad, or maybe you went to business school and you focused on finance or whatever, and you got a job at Wells Fargo, it's the expectation for those jobs is not only that you work really hard and then maybe leave, but I think the expectation is really just that you move from one bank to another. In fact, you're encouraged to. It's in some ways it's a way in which the banks outsource their training to the individual employees. So rather than spending the money on training you, what they'll do is they'll do the minimum amount of training to get you to do the job that they hire you for, but they'll expect you to learn more on the job, and then that you'll move to another job. You might move to B of A and you'll do that. And so basically, the expectation is that you develop a career by, in fact, bouncing from one company to another, collecting experiences, collecting training. It's a way, I think it's a really inefficient way of training people, frankly, but the public savings banks in Germany use a very different model, right? So they invest a lot, particularly in young people. So they really try to recruit. I mean, they have about close to 300,000 employees. So it's a big operation, right? The savings bank system hires a lot of people. And they'll hire people as tellers early on, and some people will just stay there. But then, because it's such a large system, you have opportunities to move to a different area or to another area, and there's training opportunities. But you're always within the system. And I think one of the ways that benefits the system is that you essentially become indoctrinated into the norms of public savings banks. So what that means is that you end up believing in some of the ethical issues, believing in some of the public mandate. You believe in some ways it's not completely government, but it has that era of like sort of esprit de corps and mostly I would just say just ethics. I think when we talk about banking, it's usually not in the same sentence as ethics. And in the public savings banks, it really is. I mean, and I think, again, that a lot of people ask, it's been a while since the financial crisis, but, the financial crisis, I mean, that was devastating in this country. Our economy was on the cusp of an economic abyss, and it was largely driven by greed and highly unethical behavior by very, very large banks, Lehman Brothers, JP Morgan, Bank of America, who basically took advantage of their position within the system to make really highly risky loans, knowing that the public would make them whole if they went south. That kind of behavior, those sorts of internal incentives, really are, I would say, are not present in the public savings banks because, again, I want to keep emphasizing, partly because all the parts of the public savings banks are liable for each other. And so if you
Right.
had, I don't want to just sugarcoat it. It isn't as if all the 385 savings banks operate without any problems, but they are, if there is one bank, for example, that suddenly looks like an outlier and behaves in ways that are very risky, it's immediately identified by the rest. And that bank can continue to behave that way, but there's a lot of peer pressure within the system to ensure that the savings banks behaves in a more sound and somewhat conservative manner, because at the end of the day, the incentives are such within the system that everyone would end up having to pay the cost if it went south, not the government, not the state, but in fact, the savings bank network.
Love it. Love it. And that is a perfect segue to, I think, like the last 20 years of banking and what it's looked like in Germany, in the US, and then what it could look like in the future. But first, the last 20 years. You already started talking about it, the financial crisis of 2007, 2008.
Yeah.
Banks were just taking very risky bets on not the best horses, not the best people, not the best, investments. And US taxpayers paid the costs. It was a global crisis, global financial crisis. The public savings banks in Germany did not take as big a hit. How did they avoid it? Like you mentioned, the network effect of like people actually having checks on one another as opposed to, we'll just let this slide. The shares are up. Like, how does that?
Yeah.
Here's my question: how have they survived in the face of banks really leaning into profit maximization for shareholders? Yeah, that's the question. I'm done.
Sure. No, those are all great questions. So one thing about the financial crisis that is sort of interesting, and it sort of speaks to sort of a broader narrative in among banking, which is that you know these smaller banks really shouldn't be competitive, right? They shouldn't just not be competitive because they're small, but they should also not be competitive because they're provincial. They don't know much. They're really vulnerable to being taken advantage of. They're not as sophisticated as the large bankers, and so forth. And you know, and that really there's sort of this natural selection that occurs in the banking sector, where at the end of the day, what we'll just have are just a handful of very, very large, too big to fail institutions, because that's going to be the most efficient. And I think what the financial crisis sort of showed was that is just that's just such a myth, because what you saw with the public savings bank was you saw these institutions which really are run by local stakeholders. They are under a trusteeship with local government. So even though they have a management that's a management committee that's which are comprised of bank executives and people with expertise, they're overseen by a supervisory body, like a board of directors that includes local governments. And I wouldn't say that they were the most sophisticated, but they're focused on their community. And so, one of the ways in which they behaved during the financial crisis were that the things that they didn't understand, they resisted, because they thought these would be things that might affect their community. That's their incentive structures. And I guess what's important is that obviously the savings banks didn't take a bite at that apple. They didn't do the kinds of things that larger, more sophisticated public bankers did that end up bringing down the world economy. Even though they, even though they should have in some ways been the most vulnerable, right? They should have been the ones who would be the most vulnerable to the attractiveness of, high returns, no risk kinds of pitches, that sort of thing. And they didn't. And as I said, I think part of the reason that they didn't was because of the socialization that we've talked about within the public banking system. I think it has to do with the network structure of oversight, in which all the pieces of the public banking system are liable for each other. And I think what's important about the financial crisis isn't just that the public savings banks didn't take a bite at the apple, but the public savings banks ended up being the rescue engine for the German economy, right? So what happened after the financial crisis, or during the financial crisis, was as institutions were cratering, the amount of capital available shrunk, right? So there was the institutions weren't making any more loans. That was part of the reason why the federal government in this country stepped in to bail out so many large institutions, because they recognized that if they didn't do that, banks weren't going to make any more loans to businesses, even for things like payroll, right? So and even not only that, but even to firms who really were sound, right? So even normal functioning firms wouldn't have been able to get any more loans to make payroll, and that would have really shut the economy down. Well, in Germany, the engine that really rescued the small and mid-sized enterprises were the savings banks. If you look at the lending, partly because they didn't make the same mistakes that the big banks did, they had a lot of capital that they could lend. And in fact, what happens is that most businesses have accounts with multiple banks. So they don't just usually have an account with one bank. They usually have a couple of accounts with different institutions. And what was happening, in the book, I detail the lending behavior, but there's a spike in the number of loans that public savings banks make at the very moment when private bank lending craters. And it really showed the way in which public savings banks, their stability was essential to surviving that financial crisis. And I think most people who don't understand the German economy forget that small, mid-sized enterprises are the economic engine that drives that economy. I mean, it's a country of small businesses. I would say businesses that have less than 500 people, and most of them even less than that. And And by the way, one of the things that makes that dynamic really interesting is that because of savings banks, those small businesses are really decentralized. They're really spread out through the entire country. In many countries, particularly in Europe, if you go to France, for example, or England, so much of the economy is centered around one or two or three
Yep.
large cities. Partly because whether it's Paris or London or really Lyon. I mean, really, there just aren't a lot of cities. In Germany, the economic productivity of the country is much, much more decentralized. It's in the north, it's in the south, it's in the east, it's in the west. And a lot of that is a function of the fact that businesses can be in those places and not ever have to worry about getting access to capital.
Yeah, I think I have a lot of thoughts. First, I'm just imagining a world where if the public savings banks had taken on as risky, deals as private banks, like what would have happened to the economy? And then if they had taken on those risky deals and the private banks didn't, people would have been like, see, this is why we can't have it. Shut it down. It's all over. But we didn't. And like you said, they really, really did a service to the German economy by like having that capital available. Jumping ahead to 2020, and then finally we'll pivot to the US. Or kind of like hand in hand almost, because you mentioned how the federal government was able to step in during the financial crisis in 2008. Last year, during the pandemic, lots of money flowing from the government to Ruth Chris or Joel Osteen, or lots of large corporations and businesses that maybe didn't have as much need for the money. And the money, it was very hard for small to medium enterprises across the U.S. to have access to the capital to stay afloat as the world was shut down. Not the case in Germany because of the public savings bank. So what enabled them to, I think you're going to be repeating your answers a little bit, but what enabled them to really serve their community and serve those businesses in a way that like the federal government and banks in the U.S. were unable to do so?
So that's a great case to sort of bring up because it really does sort of underscore the value added that public savings bank brings to the economy. Before I answer that, though, I think one other case that happens even before that I think many Americans would be familiar with, at least tangentially, which is the refugee crisis. Many Americans might recall that partly because of our activities in Afghanistan and other parts of the world, there was an increase in the number of refugees. A lot of people had to flee their homes because they were worried about dying and their families dying. And many of them fled to Europe in the same way that Central Americans are fleeing for safety in the United States. Europe, in contrast to the United States, welcomed them at the time. And Germany was one of the countries that opened its doors the furthest. Now, refugees are a challenge to local governments because when they come, they oftentimes don't speak the language and they have significant social needs. If they have kids, they have to figure out, well, where do they go to school and how do they get housing and all those sorts of things. The way that social services work in Germany is through banking. No matter who you are, if you're a person who needs access to social services, whether it's housing money or food money or whatever, those services are typically provided through banks. Bank transfers. The governments provide transfers through the banking system to you, which you then use to pay for the things that you might need if you're poor and needy. Well, refugees were very poor and they were very, very needy. And local governments were desperate to provide those services to them because obviously, even those governments who might not have been as open-armed as some others, still, you've got a lot of people that you got to figure out where you're going to house them and how you're going to feed them and so forth. Well, most banks, private banks, didn't want to open up accounts to refugees because they're too hard. They have funny sounding names. Maybe their identification isn't quite perfect. Public savings banks stepped in. They had to because they were part of their public mission, their public mandate. They had to provide accounts to refugees coming into the country. And there are lots of amazing cases where that happened. And the interesting thing about that is that we think of that as being like helpful to the refugees, but really they were also being incredibly helpful to local governments who, they don't have like a cash register where they just send, because that's just not how it works. They rely on banks. And so that was an example of the ways in which public savings banks really played a pivotal role in really a national emergency, in this case, refugees. Now, pivoting to 2020, it's funny that you mentioned it because I'm right now right in the middle of doing this massive project on the PPP lending program and looking at the effects of different bank types. And you're absolutely right. What happened in the first part of that program in the spring of 2020 was that so much of the money just went to large companies in large swaths and large chunks. So the average loan size was like close to $200,000 or even higher. And it was primarily made to large organizations, large companies, not small businesses. And in fact, many small businesses, particularly in poor and marginalized communities, really struggled to get access to the PPP program, partly because they didn't have accounts with the big banks or they didn't have an account at all, or and partly because the big banks, it was the sums that they were asking for were just too small. It wasn't worth it to some of these large institutions like Bank of America or others to help facilitate a PPP loan because the margins were too small. It'd be much easier to facilitate or originate a loan to a couple of very, very large enterprises and take the commissions from that rather than try to. And so the what that showed was not only the incentive structures that banks had, it also showed the ways in which banks were really important to a community. They're really essential to helping the community in the ways that I mentioned, education, other ways, but banks aren't just passive. They have to play a proactive role in helping small businesses and helping the community get access to capital. And in Germany, you're absolutely right, partly because of their incentive, because of their mission, their mandate, public savings banks, Germany had a similar program of lending to small businesses, and public savings banks really had an incentive to ensure that their clients had access to to that federal support that enabled them to survive the pandemic. And so really in what's interesting about that is almost a kind of a natural experiment because both countries adopted very similar programs at a very similar time. In the US case, you had just large swaths, particularly of very small businesses and poor marginalized communities really excluded from the PPP program. And in Germany, the satisfaction rate with their version of the small business assistance program was off the charts, like 80%. There was like 80% the satisfaction rate within the first 6 weeks of the program. I mean, they really did. I mean, I'm not saying it was a panacea and without problems. And the pandemic obviously stretched on a whole lot longer than anyone thought, making it difficult for businesses. But at least in the first 2 or 3 months, you really see a stark difference, in part because of the nature, I think, of the ownership of those savings banks and private banks.
Absolutely. So now we can pivot kind of to the United States because there are two things to discuss here. And you've hit on them all throughout this conversation, but public banks as an instrument of democracy, you talk about it in how loans were distributed. You talked about it and how they brought refugees into the system in Germany. Like being able to have access to banking was instrumental in getting them the resources they needed to fully integrate, get their kids into school, get housing, whatever. So what can a public savings bank system look like in the United States outside of North Dakota?
So, I mean, there's obviously there's also, as I said, different models of a public savings bank. A number of different states have passed legislation to make it possible for public banks to exist. I mean, I think that one thing about banking and finance in general, and this isn't just applied to public banks, this applies to lots of areas. There's no industry group in the country that includes pharma, that includes the NRA, that is as powerful and that invests as much money in lobbying as the financial industry, the private financial industry. I mean, there's just every other lobbying entity pales in comparison. So, part of we used to have, for example, in this country, we used to have postal service. The post office used to be banks. People used to be able to do banking at their postal service, and that got canceled in part because of lobbying on the part of financial institutions. And wherever we've seen efforts to create a kind of public alternative or add public banking to the mix of financial opportunities, it's fought. To be honest, especially large banks are very savvy. I think for a lot of large banks, they're sort of very good at playing smaller institutions off of one another. So as a result, one of the biggest, among the biggest opponents of public banking are oftentimes credit unions and community banks, partly because private banks kind of just play these smaller institutions off of each other. But to your question, what are the different ways in which it can look? So one way is that counties, for example, or regions of an area might found a bank, and what that looks like is that it can be something akin to what the savings banks look like. You might imagine, for example, that the tax money that you and I pay to our cities or our counties, or really any public entity in a region, could be used as reserves, right? So we pay these taxes. Typically, if you do now, you're in Houston, if you pay taxes in the city of Houston, Houston doesn't put that money in a public bank. They probably put it in private banks, where it gets sent, which in turn gets used to make investments outside of the state, and gets used to make profits that are not invested back into the city of Houston or a region. And so, one way is that a set of local governments, a region, can use tax dollars to capitalize a financial institution like a public bank, and it can behave very, very conservatively, right? It doesn't have to. It can make loans for it can make student loans that are guaranteed by the government. It can make housing loans that are guaranteed by the government. It can make small business loans that are guaranteed by the government. It can make those loans, those PPP loans, for which private banks bear absolutely zero risk because they're all guaranteed by the federal government. So but it can also be used to potentially lend to other local governments for investment projects, right? So right now, if you want to build a road, or you want to put in a new park, or whatever, a new sewer system, a city or a county has to go to the capital market. It has to raise the money through private vendors, private banks, private financial institutions. With a public entity, at least part of that burden could fall to the public bank, and as a result, make the local governments eligible for much lower rates of interest that they would otherwise have. There's just lots of ways in which the bank could use. I frankly would love it if a public bank could just be one alternative. Why not just have it? It's not like we're overbanked in this country. Why not make in some places are underbanked? So why not add a public bank to the mix? If people want to use it, great. If they don't want to use it, that's fine. But let them compete with a credit union, or with a community bank, or with a Bank America. That would be sort of ideal in my sense. They would be an important resource for individual retail customers, homeowners, local governments, and small businesses. It would just be one additional mechanism option to the competitive mix. And I think as a result, we should like competition, and everyone hopefully would be better off as a result.
I think you bring up a really important point, that competition is good. That's capitalism. We love competition. Throw in a public savings bank so you can fund some of these projects within the communities. And maybe you wouldn't have to argue so much about infrastructure spending bills because the money's coming from the communities. And that might be an oversimplification, but that can be another episode to explore. You mentioned some of the other challenges in establishing a savings bank within the U.S., in face of globalization, privatization, capitalization, whatever, those phrases are. Is there anything you think we haven't touched on that would be a good way to wrap up the conversation?
Well, I mean, again, I think that the possibility of having a postal savings bank is a really good one. I think that one of the things that's attractive about a postal savings bank is that it's large, right? So I think one of the things that comes out of my book is that politics matters. It isn't just that savings banks are sort of receptive to public policy. They really are actors. And they don't just sit on the sidelines when legislation is proposed that might undermine them or affect them in some particular way. They really are not passive observers, and frankly, they shouldn't be. They really do defend their interests and in a variety of different ways, and I think that's what it has enabled them to survive, even as comparable institutions in other parts of Europe and the United States have kind of gone away. I think that the postal banking option is an interesting one, in part because of its size. So it would be able to be pretty large quickly. And that means that it would be located in lots and lots of congressional districts. And it would be able to sort of flex its political muscle in ways that would allow it to represent its interests. I think that it's important. I think that if there's nothing that comes out of my book that people don't remember, I hope it's that, for these institutions to function effectively, they have to represent their interests, and they have to do it in a savvy way. So postal savings banks or postal banks offer that. The other part of a variety of other things make postal savings banks sort of attractive. As I said, they're large. They would be in every congressional district. Historically, they served as banks. They already do things that are similar to banks, like, you can transfer money through a postal service. You can get your passport through a postal service. So there's other things. And the other thing about postal services that's unique about the United States and important about the United States is that, banks in general don't have a great record when it comes to race. You haven't brought it up, but, marginalized communities in this country have really been at the tail end of a lot of really awful financial decisions, whether it was redlining, whether it's been discriminatory lending, discriminatory housing, racial covenants. You name it. And even today, if you look at areas that are unbanked, they're in areas that are poor, and they're typically in areas where there are people of color. That's a reality in this country. And I think a lot of particularly African Americans have a reason to be skeptical of banking just generally. I'm not just talking about private banks. I'm talking about credit unions and just generally to be concerned about banking. And I think that one of the things that's unique about public savings banks, about postal banks, is that the post office is one of the few institutions that really has a fairly strong positive reputation across incomes and across race. And there are lots of reasons for that. But I think that puts them in a really important place because it makes them start off in a positive place vis-a-vis lots of groups in this country. They already have the confidence in different societies. They don't have to deal with as much with the legacy of racism and classism that a lot of institutions do. So I think it's their size, it's the fact that they cover lots of territory. It's as I said, their size also gives them economies of scale when it comes to marketing, when it comes to training, all those other things. And I think that post offices are amongst the most trusted institutions, public or private, in the United States. And that trust isn't just for one particular group. They're actually trusted across all groups. And so to me, that puts them in a really great place to be used as banks that can serve not just one part of the country, but the entire country.
Absolutely. Well, I think that's a great place to wrap it up. Mark, thank you so much. This was super informative. I think banking is due for an overhaul to reach some of the communities you're mentioning, the underbanked, unbanked, and bring them into the system. As much as tech companies talk about democratizing access to whatever, I don't buy it. I think this is a real way to democratize access and extend access to the financial system. So thank you so much. We'll leave it there.
Sure, no worries, Ryan. It was really fun talking you up.
Awesome.
Take care.
All right.
See ya.
Thanks again to Mark for joining me on this episode of That Can't Be Right. A lot of possibilities that can bring more people, more communities into the formal economic system in America. If you liked this episode, please leave a review. If you hated this episode, @me, TCBRPod on Twitter and Instagram. Until next time.